Here is a question that sounds almost absurd when you first hear it. Would you rather live in a world where prices go up every year or a world where prices go down every year? Most people, without hesitation, say, prices going down, obviously. Who doesn't want cheaper groceries, cheaper rent, cheaper everything? And yet, every central bank on the planet, every finance minister, every government economic advisor will tell you that falling prices are one of the most dangerous things that can happen to a modern economy. They pump trillions of dollars into financial systems to prevent it. They cut interest rates to zero and then below zero to fight it. They have kept entire continents on economic life support for decades to avoid it. So which is it? Is deflation good or bad? And why are the people who run the world's economies so terrified of something that sounds like it would benefit ordinary people? Today, we are going to answer that question through 6 of history's most powerful case studies. And by the end of this video, the way you think about money, prices, and government will never be quite the same. First, what exactly is deflation? Deflation is an economic phenomenon characterized by a decrease in the supply of money or credit, leading to a decline in prices for goods and services. Although lower prices may initially seem advantageous for consumers, deflation often signals more serious underlying economic issues, such as recession or depression. American deposits. That last part is key. Lower prices sound great in isolation. The problem is what causes them and what they trigger in response. Here is the core mechanism. When prices are falling, there is an incentive to delay purchases. Why buy a TV now when it will be cheaper in 12 months? LOC. Multiply that logic across an entire economy. Millions of people delaying purchases, companies unable to sell goods, revenues falling, layoffs beginning, workers earning less, which means they spend even less, which drives prices down further, which makes people delay purchases even more. As prices fall, companies struggle to sell goods at a profit, which can trigger a deflationary spiral. When prices deflate, people hold on to their money as they wait for prices to fall even more. Inventories build, wages deflate, people lose their jobs, and GDP sags. Encyclopedia Britannica. This is the deflationary spiral, and it is very easy to fall into and extraordinarily hard to escape. But there's a second dimension to deflation that is even more insidious: debt. If you take out a mortgage and make mortgage payments of, say, £500 a month, inflation will progressively reduce the real value of your mortgage interest payments. However, with deflation, this £500 a month becomes a bigger percentage of your disposable income. In deflation, debt becomes an increasing burden, reducing spending and economic growth. LOC. And here's the part that governments never say out loud. The Federal Reserve fights falling prices to protect its power and the profits of banks and government cronies, as deflation undermines its ability to manipulate credit and the economy. U.S. Department of the Treasury. Governments themselves are the world's biggest borrowers, and deflation makes their debts harder to pay back, just like everyone else's. Keep that in mind as we go through history, because this context makes everything that follows make sense. When economists talk about why deflation is dangerous, there's one example they always return to: the Great Depression. It is the event that shaped modern central banking more than any other. It's the reason every government on Earth now has a central bank with a mandate to maintain inflation, and it remains the single most powerful argument for why deflation must be avoided at almost any cost. The Wall Street crash of 1929 triggered a collapse in demand. Businesses cut prices to try to sell their inventories. Banks began to fail, and the money supply contracted sharply, which meant deflation took hold across the entire economy. The consequences of widespread deflation were severe, resulting in job losses, wage cuts, and increased business failures, ultimately leading to a rise in loan defaults. American deposits. But the most devastating part was the psychological shift. Once people believed prices would keep falling, they stopped spending, and that belief itself became the engine of economic destruction. The Great Depression is the most well-known example of sustained deflation deepening the economic collapse and prolonging recovery. Encyclopedia Britannica. The numbers were staggering. Industrial production collapsed by nearly half. Unemployment surged past 20%. 1 in 5 American banks vanished. And the recovery, when it finally came, required not just economic policy, but a world war to achieve it. The Great Depression burned one lesson into the minds of every economist and policymaker who came after. Let deflation take hold and you may not be able to stop it. The cost of fighting it after the fact is almost always greater than the cost of preventing it in the first place. This is why to this day, central banks around the world target an inflation rate of approximately 2%, not because they love inflation, but because they're terrified of what lies on the other side. Now here is where the story gets more complicated, because history also shows us what happens when governments overcorrect, when they print money so aggressively to fight deflation that they trigger its opposite, hyperinflation. Weimar Germany in the early 1920s is the most infamous example in history. After World War I, Germany was crushed under the weight of war reparations demanded by the Treaty of Versailles. Unable to pay, the government did what desperate governments do: it printed money. At first this seemed to work. Inflation rose, but debts became easier to service. Unemployment stayed low, the economy hummed along. Then the printing accelerated, and then it became unstoppable. By November 1923, the exchange rate had reached 4.2 trillion German marks to $1. Wheelbarrows of cash were needed to buy a loaf of bread. Workers were paid twice a day because the money lost value between morning and afternoon. The savings of the German middle class, built over generations, were wiped out completely. And the social devastation of that collapse, the humiliation, the poverty, the loss of faith in institutions, created the conditions for one of the most destructive political movements in human history. The lesson of Weimar is this: there is a sweet spot between deflation and hyperinflation, and it is extremely difficult to maintain. Governments that are too aggressive in fighting falling prices can trigger the very opposite catastrophe, destroying the currency itself. It is a tightrope that every central bank in the world walks every single day. And it explains why that 2% inflation target is treated not as a preference, but as a matter of civilizational survival. But what does it actually look like when a modern advanced economy loses the battle against deflation? What does it feel like to live inside a deflationary trap for not 1 year, not 5 years, but 3 decades? Japan has the answer. Back in the 1980s, Japan performed something of an economic miracle. It transformed itself into the #2 economy in the world. From Walkmans to Toyotas, the U.S. was awash in Japanese imports, and Japanese companies went on a spending spree. It was between 1985 and 1990 that Japan reached something of a zenith in terms of economic prosperity, a period in which consumption, speculation, corruption, economic mismanagement, and excessive lending all combined to create an enormous asset bubble. In 1989, of the world's top 50 companies by market capitalization, 32 were Japanese. Japan was the future. And then the bubble burst. By 1992, Japan's asset bubble had well and truly burst. The crisis dampened consumer confidence and investment in the country throughout the decade, leading to prolonged periods of deflation. 1 lost decade became 2. 2 became 3. In deflation, the value of cash increases as time passes. In such a situation, Japanese companies began to cut wages, research and development, and other investments, opting to hold on to cash instead. From 1991 to 2003, the Japanese economy, as measured by GDP, grew only 1.14% annually, while the average real growth rate between 2000 and 2010 was about 1%, both well below other industrialized nations. Over the period of 1995 to 2025, the country's nominal GDP fell from $5.55 trillion to $4.27 trillion. Real wages fell around 11%, while the country experienced a stagnant or decreasing population. Think about that. The second largest economy in the world, stagnant for 30 years, wages falling, companies hoarding cash, a culture of thrift so deeply ingrained that tax cuts, government spending, and interest rates cut to 0 all failed to break it. The Bank of Japan gradually lowered its policy rate throughout the 1990s, introducing a zero interest rate policy in 1999. 0. And still the economy would not move. Japan became the ghost that every central banker in the world fears, the living proof that once deflation becomes entrenched in the psychology of a nation, the belief that tomorrow will always be cheaper than today, the traditional tools of monetary policies stop working. Falling price levels raise the real value of debts that households and firms owe, making them poorer and reducing their willingness to spend. Negative inflation means that real interest rates rise because central banks cannot lower the nominal interest rate below 0. Japan did not escape its deflationary trap until the 2020s, when global inflation driven by the pandemic and energy shocks finally forced prices upward. It took an external shock to break 3 decades of stagnation. September 2008. Lehman Brothers collapses. The global financial system freezes, and within weeks, the entire developed world is staring directly into the deflationary abyss that policymakers had spent decades trying to avoid. In late 2008 and early 2009, some economists feared the U.S. would enter a deflationary recession. Economist Nouriel Roubini predicted that the U.S. would enter a deflationary recession and coined the term stagflation to describe it. The U.S. then began experiencing measurable deflation, steadily decreasing from the first measured deflation of negative 0.38% in March to July's deflation rate of negative 2.10%. The fear was not theoretical, it was live, it was happening, and the ghost of the Great Depression haunted every meeting room in Washington, London, Frankfurt, and Tokyo. Governments responded with the most aggressive peacetime economic intervention in history. Interest rates were slashed to zero, trillions of dollars were injected directly into the financial system, banks were nationalized, and a new tool, quantitative easing, was deployed on a massive scale for the first time. The strategy worked. Barely. The U.S. moved outside its deflationary spiral by early 2010, but the scars ran deep. By the early 2020s, the U.S. had reversed course and entered into one of the most significant inflationary periods in the country's history, driven largely by the COVID-19 pandemic. The lesson of 2008? Governments will do absolutely anything, spend any amount, break any rule, cross any precedent to prevent deflation from taking hold, because they have seen what happens when it does. The 2008 crisis had a second chapter that most people outside Europe don't fully understand, and it played out in the Eurozone, where deflation threatened not just an economy, but the survival of an entire currency union. Eurozone inflation fell steadily in 2013 and 2014, reaching negative territory at the end of 2014. Year-on-year inflation was minus 0.2% in December, and core inflation hit a historical low of 0.7% in the same month. In December 2014, no country of the Eurozone registered an inflation rate above 1%. In 12 out of 18 countries, consumer price dynamics were negative. 12 out of 18 countries with falling prices simultaneously. This was not a localized problem. This was a continental deflationary wave. With inflation falling to 0.5% in May 2014, the ECB again took measures to stimulate the Eurozone economy, which grew at just 0.2% during the first quarter of 2014. On 5 June, the central bank cut the prime interest rate to 0.15% and set the deposit rate at negative 0.10%. Negative interest rates. Banks were being charged to park their money with the central bank, a policy specifically designed to force them to lend instead of hoard. And when that wasn't enough, ECB President Mario Draghi stepped forward with one of the most consequential sentences in modern financial history. In July 2012, ECB President Mario Draghi assured markets that the ECB would do everything it takes to maintain the euro. 3 words, whatever it takes. Markets stabilized immediately. In 2015, quantitative easing was introduced, a monetary easing operation which consisted of the ECB's acquisition of government bonds for €60 billion a month. The most immediate and striking impact was the weakening of the exchange rate and its positive effect on exports, successfully averting another Great Depression. Finally, in March 2017, the Eurozone was out of the feared deflationary territory, with the inflation rate back to around 2%. Number Analytics. It took 5 years of extraordinary intervention to pull Europe back from the deflationary edge, 5 years of negative interest rates, quantitative easing, and political brinkmanship. And the cost? In austerity imposed on ordinary citizens of Greece, Portugal, Spain, and Ireland was enormous. So step back and look at the full picture. What has history taught us about how modern governments manage the deflation threat? The answer is that the entire architecture of modern central banking is built around one fundamental fear. The world's major central banks are currently obsessed with the goal of raising their national inflation rates to their common target of about 2% per year. Not 5%, not 10%, 2%, a number carefully chosen to sit far enough above zero that deflation cannot creep in through the floor, but low enough that the economy doesn't overheat. Deflation is often tougher to combat than inflation because the Federal Reserve's biggest lever, interest rates, is limited. This makes prolonged deflation harder to reverse than typical periods of rising prices. You can raise interest rates as high as you need to fight inflation, but you cannot lower them below zero without bizarre and destabilizing consequences. The floor creates an asymmetry, and that asymmetry is why governments err on the side of too much inflation rather than too little. The only ones who need to fear this scenario are those who profit from the wealth redistribution caused by monetary inflation. And here, the story gets uncomfortable again, because a world of persistent low inflation is also a world where savers are slowly taxed, where the purchasing power of ordinary people's money quietly erodes year after year, while asset holders, property owners, and governments benefit from inflated values and easier debt service. The 2% target is not just an economic tool, it is a policy choice, one that transfers wealth in a particular direction, and one that almost no ordinary person ever voted for. So, back to our opening question. Would you rather live in a world where prices go up or prices go down? The honest answer is, it depends entirely on who you are. If you own assets, property, stocks, a business, mild inflation protects and grows your wealth. If you have debt, inflation quietly erodes it. Governments love it for exactly these reasons. If you were a saver, a pensioner, or someone living on a fixed income, deflation might sound attractive. Your money goes further. Your savings buy more. But the historical record is clear. The deflationary spiral, once it starts, is nearly impossible to stop. Japan spent 30 years proving it. The Great Depression proved it before that. And so governments have made a collective decision across every major economy on Earth that the risk of falling prices is simply too great to allow. That a world of slow, steady, managed inflation is safer than the alternative. Whether that decision serves ordinary people as well as it serves governments and banks, that is a question history keeps asking, and it does not yet have a comfortable answer. We are history vaults, and we go where the history books stop. If you want to understand who built the system that makes these decisions and how they did it, watch our last video on the families who learned to profit from every crisis: the Rothschilds, the Rockefellers, J.P. Morgan. The link is on screen now. Subscribe to History Vaults, because what's coming next goes even deeper. We are just getting